Well, good afternoon and welcome to Vincent's Federal Budget 2015 Information Webinar. My name is Brett Griffiths. I'm the Director of Superannuation Consulting here at Vincent's Chartered Accountants. And joining me this afternoon, I have Kim Reynolds, our Tax Consulting Director, along with Paul Talkington, who's the Director of one of our directors in the Tax and Business Solutions area. Essentially, the budget that was handed down last night is very much on a small business focus. Now, most of the other major policy announcements or changes that were in last night's budget that had already been released. So things like the childcare changes and also the taxing of the multinationals. So those sort of things we already knew about. So as far as what's new, really all we had primarily was the small business initiatives that were announced. So without further ado, I shall hand over to Kim Reynolds, who'll start going through some of the details in what we've discovered from the budget from last night.
Okay, thanks, Brett. So the first thing that I thought that we'd touch on, really just to get it out of the way, I guess, is in relation to the changes that have been announced in respect of multinational enterprises. Now, we've heard a lot of press in recent months, I guess, in relation to companies that operate in Australia but are perceived to be shifting profits out of Australia. So the announcement last night builds on some of the discussion that's happened previously, where the government has now introduced or drafted legislation that will apply to companies that have a global revenue of in excess of $1 billion. They've identified 30 companies in the world that this legislation will impact on. And basically what the legislation is going to do is change the operation of Part 4A, so the anti-avoidance provisions, to adequately deal with companies that artificially avoid having a taxable presence here in Australia. So I'm not going to go through the detail of it today. There is draft legislation out, so if you're interested in having a read, it is available on the Treasury website, but you can email me if you are so keen, if you need to have an early night. It'll apply to tax benefits that are obtained from the 1st of January 2016. The other issue in relation to multinational enterprises is in respect of the base erosion profit shifting issues that have been discussed at length in the past. The OECD and the G20 have taken steps to deal with this issue worldwide, and at the G20 meeting last year, governments around the world decided that there would be 15 action points that they would all agreed on, and that they would progress to make changes to taxation systems around the world to deal with how profits are shifted around the world with the changing way that we do business. Australia's decided that it's not going to wait for the rest of the world to start the process, and it's going to start implementing 4 of these actions pretty much straight away. When I say straight away, there's no legislation as yet, but it's more starting that discussion and getting some of the detail worked on at this point in time. So those 4 key actions are going to be country by country reporting. That's one that the government's looking at trying to implement starting next year, where part of the requirement for large organisations' tax affairs each year will be to provide our government with, in the tax office when they lodge their returns, details of where their income ends up all around the world. So essentially having a detailed understanding of what their business structure looks like and where the flow of funds is going around the world, so that they can identify where those profits are actually resting. That feeds then into the other 3 items that are there. Treaty abuse rules. So we've got specific treaty abuse rules that are embedded in a number of our tax treaties. They will take focus into the future as well. So they'll be the country by country reporting will enable the tax office to more easily identify where there are treaty abuse transactions going on. There are also entities that are set up around the world where they have different taxing outcomes depending on what country you're operating in or dealing with. So you might be treated as a partnership in one country and a company in another country, and you can get a different tax outcome. So there'll be a closer focus on businesses that operate those types of hybrid entities. And there are a number of countries around the world that provide special rulings to businesses to essentially attract business to their area of the world, and say that if you set up your headquarters here, then we will offer you a tax break of X or Y. And some of those deals are really favourable. So Australia's been identified as one of the countries that doesn't offer those particular rulings. And so again, this country by country reporting will allow our government to see where it is being offered and where we might be losing income and taxes from that. So now we've got the big end of town out of the way, because that's pretty much all there was there for the big end of town last night. A lot of the focus last night seemed to be on particularly the surprising aspects related to small business. And the small business changes that were announced, and we generically talk about small business, but as I'm sure that a lot of you know, particularly advisors that are listening, that small business is a defined term for tax purposes, and it basically means an entity that's got a turnover of less than $2 million. Now, it's important to remember that for those businesses that have a number of entities in their structure, that $2 million turnover relates not only to the turnover of the entity that you're looking at, but also the turnover of entities that are connected with that entity and affiliates of that entity. So if you've got a number of entities that are all under $2 million, but they're all operated and controlled by the same person, then chances are these concessions are not going to be relevant to you. So it's important to keep that in mind when looking at these next few slides. So as far as that turnover test is concerned, also you just need to be aware that it looks at where your turnover for the previous year was less than $2 million, or it's estimated to be under $2 million in the current year, or is actually less than $2 million in the current year. So there are a couple of ways to approach it, looking at the prior year and the current year. There might be circumstances where business wasn't under the 2 mil threshold last year, but is this year due to some downturn in turnover, etc. So it's worth assessing on a year-by-year basis. And it's important to remember too that it doesn't include GST, that 2 mil turnover. So getting into some of the announcements that were made, as we've heard previously, I think this was previously announced in last year's budget that the company tax rate would be reduced to 28.5% from the 1st of July 2015. Last year when it was announced, however, it was going to be a change in tax rate for all companies, but now it's only applying to small business. It does appear, though, that the current maximum franking credit rate for distributions will remain unchanged at 30%. So that's going to, there might be a little bit of leverage there to get some favourable outcomes for clients in the next in this tax planning season. Also effective it'll be effective for POIG instalments that are made from the 1st of July 2015.
Thanks, Kim. It's Paul here. So practically on that reduction of the tax rate, you'll have the situation where you'll be generating franking credits at 28.5%, but you can still pay out dividends to, say, mum and dad who are running the business, and they'll still get a franking credit of 30% in their personal tax return. Some of the listeners who are old enough to remember would have been back in the day when you had the change of tax rate from 39 to 36 and 33%. You had to maintain multiple franking accounts. This doesn't appear, based on the information provided, we're going to have that issue. So that'll be interesting in terms of what it might mean from planning. What I might say as well, and I'll be saying it a bit today, what's very important with all of the announcements are the dates and the relevant dates. A lot of the content on the radio or in the renowned financial publications such as the Courier Mail have mentioned a lot of these concessions and benefits, but not the dates that they commence and the dates that they apply to. So be very, very mindful for the advisors listening when you're talking to your clients who have heard some of these bits of good news and they want to rush out and do something. We need to be aware of what the timing is from a cash flow and from a tax benefit point of view. Also, too, another overlying comment is there's scant detail on a lot of the announcements, so the devil may be in the detail, and some of the advisors out there who had clients with the investment allowance and some of those things in recent years, what actually came out in the legislation compared to what was announced was a little bit more involved. But on the face of it, the company tax rate concession, will be a genuine benefit and assist a bit in cash flow for small businesses.
Okay, so small business, as we all know, isn't just operated through company structures. There are a number of small businesses, more and more, being operated via trust structures, and some are even, some smaller businesses are operated as sole traders. A cut in the company tax rate doesn't help those people. So part of one of the surprises last night was that there will still be a tax benefit for businesses that operate through other structures, as in sole traders or trusts. And the way that that's proposed to operate is that where individuals receive business income from an unincorporated business, again, sole trader or a trust, they'll be eligible for a small business discount. And basically that discount will be 5% of the tax payable on the business income that's been received from the entity, from the sole trader or trust. That will, however, be capped at $1,000 per person for each year. And the tax offset's going to be claimed in the year-end tax return of the individual. So that's going to be effective from the 1st of July 2015. So essentially what that means is that from if we look at a trust structure, for example, that operates a business, there may be business income as well as some passive income in there. If the business income is distributed to individuals, then the individual will get a 5% discount on the tax payable up to that $1,000 tax offset in the year. So it is a bit of a concession, but again, it does have to go through to the individual. Individual tax rates won't be changing, but this discount on business income will assist in those circumstances as well.
So Kim, it's almost a bit like the old entrepreneur's tax offset 2.0 maybe.
Yeah, a little bit like that. That's right, but just a wider net, I guess. So the next item that I think did surprise many people last night was there has been some talk prior to the budget about businesses wanting an accelerated depreciation write-off, and the numbers that were being bandied around were, $10,000. The government, I think, surprised everybody last night when they said that there'd be an accelerated depreciation write-off of up to $20,000 per year. Its operation appears to be similar to the small business tax break that we had a few years ago, where the asset's use, you must start to use it or have it installed ready for use after 7:30 last night and by the 30th of June 2017. It is going to be on a per asset basis. As Paul just mentioned then, that the devil's always in the detail with some of these things. You might remember when we had the small business or the business tax break, that where there were a number of assets that were identical in nature, then they could get grouped together. It doesn't appear that that's the case at this point in time, but we'll wait and see what the law actually says when it comes down.
And Kim, Mr. Hockey said unlimited numbers of assets, and he used vans, kitchens, and all sorts of strange cars.
All sorts of things, yes.
But I think before we all race off and go and buy a new kitchen, probably need to clarify what the legislation looks like. But where there's some very important and critical planning opportunities, in that $20,000 threshold is if you're, one of the examples given, in installing a commercial kitchen or something that's going to cost you $100,000 to fit it out, and you've got certain discrete boilers and cookers and ovens and thingamajigs that an aggregate would cost more than $20,000, you need to go through with your suppliers and very carefully break out those invoices. Conversely, you probably couldn't buy a Bobcat or a Kanga bit by bit to get it below the $20,000 because it's not a discrete operating asset. So be very mindful in terms of, for the advisors listening, if you've got enthusiastic clients who are maybe trying to be creative and get things below the threshold, you need to be very mindful in terms of what you can do and how the actual asset is going to be used on its own.
That's right. So the other item in relation to depreciation was, for those of you that use the simplified depreciation regime, you'll know that once, if you get kicked out of that regime or elect to go out of it, you get locked out for a period of 5 years, so you're prevented from re-entering for that period. That rule is going to be suspended until the 30th of June 2017. So if it will enable small business to jump in and out of that regime if required.
So Kim, there's another critical date-driven initiative.
A date that's a long way off.
A long way out of our minds.
So the next change is a issue that was raised last week, I think it was, that in order to allow small businesses, startups, to structure themselves properly and at a reasonable cost, I guess, from a tax perspective, sometimes that can be quite daunting for taxpayers, where they might have set up a structure, acted in their own name for a period of time, and then wanted to change to an entity structure. There's not currently a provision in the Act to allow a rollover for capital gains tax purposes. So if you were to change from an individual to a trust, for example, and a discretionary trust, then there would be a taxing event that would occur because you'd essentially have to sell your business across. This proposal is that there will be a CGT rollover available for a change in entity structure from an individual to a trust. It'll be effective from the 1st of July 2016. So it's something to keep in mind for those small businesses that are around that are looking to restructure into an entity structure as opposed to operating in their own name. There's always the issue of, do you hold off to get the benefit of a rollover that might be there? It's a matter of doing the work, I guess, beforehand to see what values are attributable to the business itself, to see whether the cost saving is really going to be sufficient to warrant another 12 months of waiting until a rollover exists.
I suppose too, Kim, practically as well, the announcement last night was very scant on detail. The example gave from an individual restructuring to a trust, but there was no discussion as to whether a company or whatever other entities could restructure. But often what we see is you'll have someone who starts out trading in their own name to give it a go, and then their business grows and maybe they're looking at taking on staff or getting further up the risk curve, and for the advisors out there, we'd be advising to say, look, you really need to have a corporate structure in there somewhere to help protect you. But at the moment we can only roll over into a company, and as you know, there's maybe not favourable CGT outcomes if we have business real property held by a company. So that, from the, I suppose, the tax management point of view, is not pleasant. So yeah, as Kim said, do you wait another year, or from a prudent business risk point of view, do you just go ahead in what is the current legislation? The other thing we need to be very mindful of as well is, I'm not a betting man, but I don't think the OSR would be coming to the party and exempting stamp duty on any restructures and these things. So you're probably going to have that cost in the forefront of your mind. also too, if the restructure has depreciable plant or trading stock, you've got other tax issues that might cause tax leakage from doing that. But I think as advisors, this and as a concession and idea for managing risk for clients, it's a positive step forward.
Okay, the other item that's on the slide there is in relation to FBT. At the moment, the change is in relation to there being no FBT on situations where there is more than one work-related portable electronic device provided to an employee. Now this will apply from the 1st of April next year, 2016. Essentially it's been put in place to remove the confusion there exists between, electronic devices now have a number of different functions, so there can be some overlap between your phone, your tablet, your laptop. So previously the FBT regime didn't deal with that very well, so they're essentially removing that more than one limitation from the law is proposed. Now in relation to, again, still small business but focused specifically on startup businesses, there's proposed to be an immediate deduction for professional expenses that are associated with starting a new business. So if you start a business at the moment and you incur costs of setting up the entity, advisor costs just on what should I do, how do I manage the business, etc., etc. Those costs are not immediately deductible under the current law, but are referred to as black hole expenses, and as such they're deducted over the next 5 years. So this proposal is intended to change that and offer an immediate deduction for those professional expenses for starting that business. That is going to be effective from the 1st of July 2015, so in a few weeks' time.
And Kim, in the commentary it talks about legal expenses in establishing entities, so that could extend to your shelf company costs or your shelf trust costs if you go and set up a new structure.
Well, generally, that's right, because generally your shelf company structures are backed by a law firm. There's a lawyer that's drafted those constitutions themselves.
I suppose a practical consideration would be, because we're halfway through May and we're getting near to the end of the financial year, unless there's a pressing commercial need, we often see clients who say, well, should I set up my entity in the middle of May or June? And we often say we're going to have to incur professional costs in doing the annual accounts and tax returns and those sort of things. With this concession starting from the 1st of July, if you're able to, you'll save a year's compliance costs and you'll be able to get a deduction for the setup costs if you can hold off to the beginning of the next financial year. So that's something to consider when you're talking about planning with your clients.
Okay, so now for a change in topic, GST side of things. There wasn't a lot really announced in respect of GST last night. There has been some talk in recent times about changing the current GST-free treatment of going concerns and farmland, and essentially substituting that with a reverse charge mechanism. That was announced last night that that's no longer going to proceed, which is probably good news for those of us that had read through it. It was more complicated than I think it needed to be. So the current rules are working for the most part anyway. The other item in relation to GST is that, as I'm sure many of you will be aware, that there's been a compliance program running in respect of GST to ensure that the GST tax base is protected from the revenues perspective. That compliance program is going to be extended for another 3 years, and I imagine in 3 years' time we'll be sitting here saying it'll be extended for another 3 years. So you can expect to see or continue to see GST compliance reviews being undertaken by the tax office. There's been an awful lot of press in recent years in respect of the low value threshold for GST for imports. There was no discussion about that in the budget last night. That $1,000 threshold limit remains. However, I expect that at some point in the future it'll come up again and there will be some changes. But at this point in time, the $1,000 still sits there. And the last item, and I guess the main change in respect of GST that was announced, was what's been commonly referred to as the Netflix tax. So GST in respect of offshore intangible supplies. So where I stream my television or movies from Netflix or some other streaming provider, those services at this point in time don't necessarily have GST on them. Where they've been sold to an Australian consumer, this Netflix tax will change that process. It'll be effective from the 1st of July 2017. Interestingly, although it's referred to as a Netflix tax, the wording of the announcement last night did say that it included services. So where services are provided to me sitting here in Australia by a US advisor, for example, then it appears that that will be included in the net as well. The practical machinations of how that's going to work is I'll leave that to the people that need to develop the software to make sure it's all collected and picked up when I click the button to say that I'm acquiring the services. But yeah, they've got till the 1st of July 2017 to work that out.
And Kim, I note that commencement date of 1 July 2017 coincides with the new Series 4 of House of Cards on Netflix, so maybe they've negotiated that with Kevin Spacey. Or Francis Underwood, sorry.
Possibly. So on to personal tax issues. The budget deficit levy, that extra 2% on the top marginal tax rate that's with us until 2017. At this stage it's not been extended, so that's going to rest until 2017. The other change in relation to personal taxation were changes to work-related car expenses. So essentially that system of claiming work-related car expenses is to be simplified from the 1st of July 2015. The two more popular methods of claiming car expenses, cents per kilometre and the logbook method, are going to be retained, but the other methods, the 12% of original value and the 1/3 actual expenses, are going to be dropped and discontinued. One additional change in relation to the cents per kilometre method, though, is that you'll be aware that the cents per kilometre that you can claim in respect of your vehicle depends on the size of the vehicle that you're driving. And I think they've done some research to say that the top 5 selling cars in Australia averaged at a 66 cents per kilometre rate, so they've decided to introduce a flat rate for the cents per kilometre method. So everyone's going to claim at 66%. So if you've got a little 1.2 litre engine or you've got a 3 litre, it's not going to make any difference from a claiming perspective. It'll be 66 cents per kilometre. And
Kim, in their financial review today, they've called that the Toorak tractor provision.
Yes.
With people who've got large fuel inefficient 4-wheel drives. The other thing that the issue is going to be is you can claim your 66 cents per kilometre up to the 5,000 kilometres. If you want to go above that, you need to maintain a logbook under the existing logbook substantiation provisions. Again, if I were a betting man and I was the ATO, I'd be hiring a lot more logbook auditors, because people will probably just be claiming business percentages and not having the correct substantiation. I'd probably get in quick for your clients, because I can see newsagents selling out of logbooks in the not too distant future, seeing this commences from 1 July 2015. So there's those dates again. Clients have got to look at their logbook compliance if they haven't done that previously.
Okay, in relation to the zone tax offset, now, the zone tax offset is not something that pops its head up in budget discussions very often, but this year the government's decided that it should reduce the eligibility criteria for the zone tax offset, essentially restricting it to those taxpayers whose normal residence is actually in the zone. So effectively it rules out fly in, fly out, or drive in, drive out workers from claiming the zone tax offset. A number of those workers will have satisfied the more than 6 months in the particular zone because that's where they work, but they might live somewhere else entirely. In those circumstances, they're not going to be eligible for the zone tax offset in the future. The other change in respect of the way that we're taxing workers is in respect of temporary working holiday makers, so backpackers that might come out to Australia and be on a working holiday to travel around the country. Essentially, they're going to be treated as non-residents for tax purposes, regardless of how long they're in Australia. So they will start paying tax from $1 of income rather than having the access to the tax-free threshold. And that's going to be effective from the 1st of July 2016.
So Kim, as it stands prior to the new legislation, they got the 183-day test. So if you're foreign backpackers in Australia for more than half the tax year, they're taxed as a resident. There's now no good. Or they've got another year. They've got another year's tax-free threshold as it doesn't come into 1 July 16. So.
That's right. Yes. The other item that, not necessarily a surprise, I guess it was talked about in the last couple of weeks, was in respect of students with help debts. Where students have new and existing debts and they head off overseas for a period of time, under the current way things operate, those taxpayers aren't chased for their repayment of their help debt, even if they're earning in excess of what the minimum repayment start date or starting salary is. That's going to change effective from the 2016-17 year. So essentially, those that have got debts will need to register with the tax office if they're going overseas for more than 6 months, and if they're already overseas, they need to register by the 1st of July 2017. 1st of July 2017 is going to be the date where the repayment obligations are going to commence, and that'll relate to the 16-17 income that they've earned. A little bit of a compliance nightmare, I think. I don't know how many people are going to be voluntarily registering with the tax office when they're going overseas. It's probably the last thing on your mind to register with the tax office that you're going overseas, but something that we need to be aware of anyway, and probably that the parents need to be aware of, that it's going to be there.
I'm sure Big Brother will help them with that though, Kim, in relation to their visa applications and things like that.
That's a very good point, yes. Okay, other business changes. There's been some discussion in recent times about crowdsourced equity funding, so looking at methods by which there can be greater access to public funds for startups and the like without going through the compliance and regulatory nightmare that you would normally have to do by setting up essentially an unlisted public company, for example. Those rules are going to be relaxed a little, made easier to allow people to get access to them when they're on the small end of town rather than the big end of town. So that will help a lot of startups around the place. That, together with the employee share scheme changes, will be a great benefit, we think, to the startup sector. Streamlined business registration. For those accountants out there, we will have heard a lot of talk in recent times in the tax office talking about how they're going to be streamlining the way that they receive information and obtain information in relation to taxpayers into the future. The proposal announced last night is that there will be a single online registration site, so for tax file numbers, ABNs, all of those, GST registrations and everything else. So there's going to be quite a mind shift, I think, on behalf of taxpayers and advisors over the next few years as to how much information is going to need to be dealt with electronically through the digital space, and there'll be automatic streaming of information to whoever the government deems needs it. Managed investment trust measures that have been proposed for quite a while now have been deferred for another 12 months, so they are not proposed now to start until the 1st of July 2016. And FBT meal and entertainment concessions that relate to the not-for-profit sector, those employees will be capped at $5,000 for the grossed up amount in relation to the FBT meal and entertainment benefits that they receive, and that'll apply from the 1st of April next year. That's something that the charities section or the not-for-profit sector has been expecting for a little while, because it did seem overly generous even to that sector. Dividend imputation. There were no changes announced last night. There had been some talk that there would maybe be removal of the dividend imputation system, but the government has decided not to do that, just like they were silent on negative gearing. The ESS amendments I've mentioned just briefly, and they've received some press previously, so I won't go through those today. The other surprise last night was in relation to some allowances made for primary producers. So primary producers will get an immediate deduction for fencing and water facilities that they build, and fodder storage assets that generally have a depreciation or an effective life for up to 50 years, I think, can be depreciated over 3 years. That's going to be effective from the 1st of July 2016. So there's some positives in there for primary producers to allow them to get access to more upfront deductions rather than over the life of some of these assets that have quite a long effective life.
I suppose, Kim, the other practical issue with this is because the provisions don't commence until a year's time, no one's going to put any fencing or fodder or water storage subject to cash flow for the next year, and then there's going to be a great big rush. We note that these provisions apply to all primary producers, not small business primary producers. There's no cap, no limit, no time limit. And also, too, with some of the struggles that the rural sector's got, they've got to have the cash flow to be able to do it, or someone to finance them. But yeah, it was a surprise, but I suppose it's an incentive.
On the tax compliance side of things, an increase in penalty units was announced, so the value of Commonwealth penalty units is going to increase from $170 to $180 from the 31st of July this year. And they'll also be indexed every 3 years by the CPI. The first indexation is going to start on the 1st of July 2018. Some of the ATO penalties that will impact on include the failure to lodge an income tax return or another other document by the due date, which I'm sure is all front of mind for all of us advisors, given 15 Mays at the end of the week. Where statements are made or schemes are undertaken with intentional disregard to the tax law, or there's recklessness or failure to take reasonable care, it will impact on those, and also breaches of the SIS Act will also be impacted. So now I'm going to hand over to Brett, who's going to talk through some of the announcements in relation to families, pensioners and superannuation.
Yeah, thanks, Kim. So I suppose starting with the parental leave scheme, once again, this was something that was announced prior to the budget last night, so we already had the detail essentially, or as much detail as available on this. So essentially what this relates to is stopping the ability for eligible parents to double dip. So where some employers will have a paid parental leave scheme already, and then the employee accessing the employer's scheme as well as the government scheme. So from 1 July 2016, this provision is essentially going to stop the eligibility to the government scheme if the employer's scheme is more favourable to the employee. So it's sort of just tightening up a little bit, as I say, on that double dip. Childcare, obviously we had Scott Morris on the weekend making this announcement, so once again, nothing that we didn't already know about. Essentially what they're doing is changing the way in which the childcare subsidy works. So at the moment it's a 50% subsidy on the childcare fees, and that's based on regardless of your income or asset levels. So what they're now actually doing is they're introducing an activity test as well as a means test. So families with incomes of up to $60,000 will be eligible for an 85% subsidy, a subsidy of 85%, the lesser amount of the actual childcare fees, or the benchmark price per child. If the families are earning $165,000, then that reduces down to 50%, and if they are earning over $180,000, the cap kicks in at $10,000 per family, or per child, I should say. So essentially, if you're earning over $180,000, you can't claim any more than $10,000. Now, I suppose the thing to bear in mind is that these arrangements essentially, they've said that they are subject to other measures being passed by the Senate that are sitting in the Senate right now. So that means that it's all well and good to have this new policy, but when we'll actually see it implemented may be another question, because the Senate at the moment, the crossbenchers and Labor, are saying that they will not pass the measures the government wants them to pass for this to get through. So although they may want it to get through both houses of Parliament, it may take a little bit longer than what they're anticipating. So I suppose the message or the takeaway from that is don't be expecting your subsidies to change in the near future for your childcare provisions. Now, superannuation. Now, there was obviously a lot of speculation about the superannuation changes coming up to the budget, and with both people within the industry talking about pensioners and everything else. Anyway, essentially from last night, the sum total of the superannuation changes are on that slide. Nothing. Essentially, there were no changes announced in the budget last night in relation to super, which is a great thing, because super is basically, in the past, has been the kicking dog of tax revenue within the budget. Now, I suppose my take on that is because at the moment we have a consultation paper kicking in the background that, so a consultation paper that's a green paper that will turn into a white paper that will involve industry consultation, and that relates to not only superannuation but also for tax arrangements as well. So those, and I think that's why we're also not seeing much in the way of tax changes, is because we have this consultation process going along, which will be due to be handed down later this year, that will come up with presumably some recommendations, and from that the government will try and get bipartisanship in relation to the legislation, so things are not to end up being stuck in Parliament. They'll actually get progressed and we'll have some more certainty, so which will then lead to business confidence. So I think the way that they're going around about this process is a great thing, and I'm expecting that the next budget will be a lot different in relation to tax and superannuation, but time will tell. The only change from super, and that's why the previous slide said no real changes, the only change essentially to superannuation itself was the ability to access super if the member has basically terminal medical condition. So under the superannuation legislation, if a member has a terminal medical condition and they have 2 doctors that certify that their life expectancy is less than 12 months, they're able to access their super as if it was a death benefit but still being alive. What this measure will do is, with effect from 1 July 2015, essentially extend that 12-month period to a 24-month period. So 2 doctors need to certify that the member will essentially pass away within the next 2 years, and they'll be able to access their superannuation. So that was really the only change that was from last night. Moving on to the age pension. Once again, this was pre-announced before the budget, so nothing new in this. So just quickly in summary, the value of the assets that an individual can have in addition to their family home to qualify for the full pension will actually increase from the current rate of $202,000 to $250,000 for a single homeowner, and up to $375,000 for a couple where they own their home. The threshold for the non-homeowners increases by another $200,000 above those amounts. So essentially what they're doing is they're making it more accessible for people to access the age pension based on their asset values. I suppose at the same time, what they're also doing though, is they're reducing down the number of assets that you can have to access the age pension, a part age pension. So at the moment, the threshold's 1.15 million, so that will be reducing down, so less people will access the age pension. What they have also said though is that those that are affected through that scaling back process, they will still maintain their eligibility for the Commonwealth Health Seniors Card and also the Commonwealth Care Card, the Healthcare Card. So although they're losing the part pension, they're still maintaining their access to those particular auxiliary benefits. Defined benefit pensions, a bit of a social security means testing going on here, which is interesting because this will essentially affect politicians as well as public servants that are on as part of an older defined benefit arrangement that they would have been on. So essentially what it means is that they're imposing a cap on the deduction that's available under the income test from 1 January 2016. So this deduction will be limited to 10% of the value of the annual defined pension. So that means that previously, going back to 2006 and prior, the deduction was actually 100%. At that point it changed to 50%, now it's dropping down to 10%. So those people that are receiving a defined benefit pension from the public sector or corporate schemes, so the likes of Q Super, for argument's sake, they still have defined benefit pensions. They will actually have, for accessibility purposes, for the social security mechanisms, that deduction will drop down to now 10% rather than 50%. So once again, the idea is to get more people away from the age pension. Aged care, there was once again some tinkering around the edges around the aged care in relation to means testing. So where residents who pay their accommodation via periodic payments will basically be aligned to those who pay via a lump sum by removing a rental income exemption that currently they're available to those who are paying via the periodic payment method. And this will apply from 1 January 2016. That's the intended start date. So that's really all I have. And Kim, I think you've got a couple of matters just to quickly finalise with.
Thanks, Brett. Yeah, just a couple of other things that were announced last night, not specifically tax related, but things that we, I guess, should be aware of. First one on the list there is there's been an announcement in relation to a serious financial crime task force. This was actually announced earlier in, I think it was last week, where the government's announced that it's going to establish this task force to fight serious and organised financial crime. The Project Wickenby task force is supposed to be finishing up on the 1st of July this year, and this task force essentially is going to take off where that left off and deal with, it's going to be a multi-agency task force that will deal with tax avoidance, evasion and fraud, and in relation to white-collar crime. The other item that we've heard a little bit about in the press recently are changes to the foreign investment framework. So we saw an announcement recently where the government said that it was going to crack down on foreign buyers of particular types of land. So those announcements have been formalised in the budget papers last night. The reforms are basically going to allow the tax office to take over compliance and enforcement of these rules, and they'll use a lot of their data matching systems to enable them to identify individuals or entities with parcels of land in various locations. There are going to be stronger criminal and civil penalties for breaches of the rules. They're going to introduce an application fee process to administer the screening of these foreign investments. There's also going to be increased scrutiny around the agricultural investment side of things. So, an example of the penalties that the government's looking at is that these criminal penalties for breach of the rules will be increased to a maximum of $127,500 for individuals, or 3 years imprisonment, or $637,500 for companies. There are also going to be civil penalties of 10% of the purchase price or market value, along with the payment to the government of any profit that's made on sale. So they are looking to get quite tough on this. I think in the announcements that they made earlier in the month that they were giving foreign buyers or foreign owners till the 30th of November to come clean, I think were the words that were used. And I guess that's with this in mind that this framework's going to start on the 1st of December. The other item there that I find is an interesting one is in relation to a statutory remedial power for the Commissioner of Taxation. It's essentially a power that's going to enable the Commissioner with a power to make a legislative instrument to modify the operation of the tax law that will ensure the law's purpose or objective is achieved. So not only will we have legislation that goes through the Parliament and everybody, it passes and we will abide by that. We've got the courts that make decisions based on particular facts that form part of our law. We're now going to have the Commissioner deciding that particular parts of the things that didn't quite go his way, that he may be able to change the law to give it its correct intent. So it's been an interesting one as to how that is actually played out. This power is supposed to be put in place to allow the Commissioner to administer the law consistently, where it has a beneficial outcome for affected taxpayers, and it is no more than a negligible budget impact. So we won't see wide-ranging changes, but there will be enough to make us be aware. And the last thing that I wanted to just point out is that the introduction of this Northern Australia Infrastructure Facility. The government's going to provide $5 billion in a concessional loan facility to promote infrastructure investment across Northern Australia. It's basically going to be established to fund major infrastructure projects such as ports, railways, pipelines, and electricity generation. So there's a real push, it seems, to be moving a lot of what we do, or some of what we do, up into Northern Australia rather than in the southern states or just the eastern seaboard. So this loan facility is going to be open from the 1st of July 15, and yeah, it's something to, I guess, to keep our eye on to see if there are other opportunities that arise because of, I guess there'll be increased employment in those regions, and it may then further flow on to small business and that sector as well. Okay. So I think that's everything for the budget. Thank you everybody for listening. If you've got any questions in relation to the things that we raised today, feel free to drop an email to Paul, Brett, or myself. And I understand a copy of the webinar has been recorded and will be sent out following the finalisation sometime this afternoon. So thanks everybody for listening, and we'll talk to you again soon.
Thanks very much.
Thank you.